Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions, generally related to wealth building, financial topics, and or commodities. So let's dive in there. Let's take a look and see what people are sharing. If you want to follow me, it's at @Finance. And if you want to join our community, it's finding-value.com, where I dive deeper into individual sectors and companies. And you can see what I'm doing during this commodity bull market. What I have been doing, though, is basically accumulating companies for the bull market and holding on. I'm not trading in and out. I am holding on and getting really what I think are really good buy points and cost averaging in at opportune times. And if you have a similar viewpoint to that, I would definitely try to sign up, at least try it. And we do have a coupon code Mayday, one word, Mayday. So the Kobayashi letter says more evidence stagflation is beginning. U.S. manufacturing activity fell into contraction territory again in April. The ISM manufacturing PMI index dropped to 49.2 in April from 50.3 in March, missing expectations of 50. And 50 is that kind of neutral spot. You're not growing and you're not contracting. We are contracting a little bit with the 49.2 number. So excluding March, U.S. manufacturing has been in contraction since November of 2022. The worst part, prices paid spiked to their highest level since June of 2022 due to rising crude oil, aluminum, steel, and plastics. Input costs are surging, adding more inflationary pressure to the U.S. economy. At the same time, the economic growth is stagnating. Yet another data point signaling stagflation. And that's what we're seeing. We're seeing a contraction in manufacturing and an increase in the consumer price index. Silver surfer. So we've got silver continuing to move lower as expected. My highest probability target for a pullback was 26.40 to 25.30. Yeah, it's probably about where I'd put it. 25.50 to 26 bucks. We've achieved the minimum target of 26.22 to be exact, and now look to take out that level shortly and could be heading towards lower end of the target zone. I have a secondary target zone at 24.90 to 24.15, but that seems less likely at this stage. A move to those levels would most likely be due to what the DXY is doing, breaking out above the October 2023 highs. And he's got this chart here. This is just a inverted flag pattern, but he's got all the writings on it. So he's using Elliott wave pullback here, and that we have a fifth ending, end of the correction phase, somewhere in the $25 to $26-ish range is where we could potentially pull back to. And I would agree with that. That'd be a full pullback on the breakout. That there is where I would start to accumulate again. It says, I wonder if Buffett used Excel and built models, or Lynch, or Wilson, or Druckenmiller. I doubt any of these guys did. Probably not Greenblatt either. Why do so many people think the way to beat investing is through a spreadsheet? Why do people waste so much time with them? I would actually agree with that. It's a waste of time. And I know a lot of people, ask, I want to be able to read a balance sheet. And I'm like, okay, so if you read it, what do you get out of it? And that is really what you want to ask the question. So if you read the balance sheet, you look at it and you say, okay, people usually say, well, this company is losing money. I'm like, yeah, it's a commodity company at the bottom of a commodity bull market. They lose money at bottoms and make money at tops. You can't look in the rearview mirror and be a successful investor. And I don't think you can project the future of future cash flows as well as maybe some people think. And that's where it becomes an art form. It's not about number crunching. I think the question is, what is the probability or what is the chances, given the market conditions that we are in, that commodities are going to go up or down? Then you look backwards and say, what conditions does oil go up in? Inflationary conditions. Have we seen oil make a substantial move in non-inflationary conditions? No. So it's most of these commodities, like 99%, or maybe not that high, maybe like 90% of the commodities, maybe about 90% are driven by the macro forces and the demographics. And every time I've seen that in history, it's been because of the demographics and the inflation in the system. So, yes, there's some oddball, like palladium's an oddball, and there's some other commodities that are oddballs that may move differently, which is fine. But the majority of these moves are macro driven, they're not sector driven. And I know a lot of people get their head wrapped around the sectors. The question isn't if the sector is bullish. The question should be, what is going to cause money to rotate out of what they are currently holding? And generally, what happens is they're in an asset, and when that asset stops working, that is when the money rotates. So, what's more important, in my opinion, isn't that the asset is working, it's that the asset of another asset is not working, and the people have to move from that asset to something else. So bonds are not working, and bond money is moving to something else. Eventually, it's going to be tech stocks that don't work, and that money's going to move and rotate to something else. And that's when everybody gets the FOMO in those other sectors. The spreadsheet's not going to tell you that. A spreadsheet is so far away from what I just described that it's a big waste of time, and I completely agree with that. Now, there are things that you can do to evaluate companies that control their selling price. Commodities are macro driven. The other companies may not be as macro driven. So those are companies that control the selling price of their products, like technology stocks like Apple. But you get into a certain market condition and those go down because of the way that the asset is being valued by the spreadsheet guys. The interest rates go up. So really, what you're betting on is interest rates going up or down. And if they're going up, most likely you're in an inflationary condition. So commodities do well because money rotates out of the stuff that isn't working, which is bonds and a lot of the stock. And then it goes into precious metals and commodities, which I think is coming. It says, Nick, how do you know when an asset is in a bubble? When you see a lot of people making a lot of money that wouldn't normally be making a lot of money. This signal won't help you time the bubble, but it will identify it without fail. So when a bunch of people who aren't supposed to have money start making money, that's when you're in a bubble, according to him. So here's his most favorite advice. Let's read it real quick. So best advice he ever got from Jim Rogers. He says, the best advice I ever got was on an airplane. It was in my early days on Wall Street. I was flying to Chicago and sat next to an older guy. Anyway, I remember him being an old guy, which means he may have been 40. He told me to read everything. If you get interested in a company and you read the annual report, he said you've done more than 98% of the people on Wall Street. And if you read the footnotes in the annual reports, you will have done more than 100% of the people on Wall Street. I realized right away that if I literally read a company's annual report and the notes, or better yet, 2 or 3 years of reports, that I would know as much or more than others. Professional investors used to sort of be dazzled. Everyone seemed to think I was smart. I later realized that I had to do more than just that. I learned that I had to read the annual reports of those I am investing in and their competitors' annual reports, the trade journals, and everything I could get my hands on. But I realized that most people don't even bother doing the basic homework. And even if I did even more, I'd be so far ahead that I'd probably be able to find successful investments. That's from Jim Rogers. And here's one thing that I'll add to this. If you guys are interested in a sector, go to the earnings calls of the companies. You can tell by the way the CEO or CFO or COO, depending who's on the call, you can tell by their answers if they're doing well or not. You can tell if there is positive sentiment or negative sentiment inside of that company. You can tell by a whole bunch of things of how they answer the questions. So some of the calls that I've been on, I've been in a, no, I just listen to them. And I listen to a lot of the energy and energy service sectors conference calls, the earnings calls and stuff. And when I listen to them, you can tell they are very positive. They're like, "Yep, this is a multi-year cycle. This is what's coming. This is what's kind of expected." They can't give exact numbers, but they can give you a general overall like view of it. And it's really hard for these guys to be, if you listen to 10 or 20 different companies' earnings calls, and you can do that at 1.5 times speed, and it only, some of them only last 30, 40 minutes. And divide it, at 1.5 speed, divided by two almost. Maybe not two, but a little less than that. But you can gauge like that whole sector pretty easily. And then you can also gauge how, if you're listening to drillers, how the exploration production companies are doing, because that's their customer. So you can actually do quite a bit and get a pretty good gauge of what's going on by just by just listening to a bunch of earnings conference calls in a bunch of different sectors. Coming on down, Michael says last year many economists were predicting recessions that never materialized. What's a plausible explanation for this remarkable divergence? I think that we are going through a slowdown right now. And what's going on is that fiscal spending is hiding it all. And they're under accounting for inflation. So inflation's probably like 10%. And then they adjust it way down, and that's what makes GDP positive. It's an under accounting of inflation that is pushing the numbers higher. So if we look at here, they've got the US Conference Board leading lagging index, which is really negative, and then the US real GDP year over year is positive. That's the inflation that they're printing from fiscal to basically hide it. That's what I think is occurring. The housing market is strong because we're just in a straight deficit. Like we have very low inventory and a huge demographic. But I do think that the economy is weak, manufacturing and stuff. And inflation is just hiding it all. Here's low prices for natural gas. So production is pulling on back quite substantially from where we were in earlier of this year. So earlier this year, we were way up there, 105, 106, and now we're down at 99, a little below 99. Patrick Karam says, who has got an eye for those yields? 10-year yield looking to burst upwards versus the 2-year. I guess there's hope for the gold and silver miners after all. And this is the 10 versus the 2. And you can see I do this too. And you can see the breakouts of these also in every single occurrence here. And to me, it looks like we've got a pretty big breakout ready to come, because we're at a very low level. We've got a lot of runway for this yield curve to uninvert if it does uninvert. And hopefully you guys can see, there we go. We've got a good long runway for potential uninversion here of the yield curve, which gives us a runway for silver to go up. Dow equals gold, or Dow gold equals 1, I should say. It says, and that's the ratio. With the largest cup and handle in history of charts, silver's going to boggle minds on its way up to $666. That's a great, great number there. That's a 25x from where we sit today. Can't happen. Silver went 37x from 71 to 1980. So he's projecting a potential move in silver of $666. And that's where we potentially could go, in his opinion, based off of the size of this cup here, projected off the top of the cup and the handle. Big move, but that's still out in the future. That's when that uninversion of the yield curve comes, et cetera, et cetera. Z4 Energy Research says in 2025, U.S. will export more liquefied natural gas. Texas Gulf Court will need more gas. There is not enough pipe capacity from the Permian. It's going to come from the Haynesville gas. And guess what, guys? That's where our natural gas producer that we've been buying, that's where it's exactly located on the website there. Robert Friedland, copper. It says the world is poised on the edge of a new copper supercycle. And you guys have heard me say supercycle before, and now it's starting to get out again. Yes, we're on the verge of a supercycle for a lot of different commodities. We're just at the very beginning of it, the beginning of the beginnings. And this is where you can position. We've got great technical chart setup patterns right at the beginning of stage 2 for a lot of different sectors. Now's the time to take advantage. And if you're patient enough to hold through this super cycle, you can make a buttload of money. And a lot of these companies, guys, a lot of these companies are paying big dividend yields. Those big dividend yields are what? Easy to hold on to, exactly, because if you're getting paid 10% dividend yields, well, that's pretty easy to hold on to, in my opinion. So that's what I'll say there for copper. We've got North Star here. He says the NASDAQ 100 is a massive loser versus Camco. A rotation away from stock markets towards commodities, precious metals, gold, silver is just getting started. I agree with that 100%. And in the 1970s, tech was the worst performer, commodities was the second best performer, and precious metals was number one. And here we are heading lower in this ratio where Camco is outperforming the NASDAQ. That happens during bull markets of commodities. Uranium miners versus uranium the metal, clues for a bull market, and we are still at the early stages of the uranium equities and how cheap and early we are versus the physical metal itself. What he says is up here, uranium miners are at peak valuations versus the metals. Down here, uranium miners are at low valuations versus the metal. We have another UCAST is coming soon for members. And then we've got the move upward into the ARC target, and the bull market could bring us up here. Big moves if that were to occur for the equities. And guess what, guys? I think we are potentially at the beginning of those really big moves in uranium equities. JC Parrott says, are these the most important consolidations in the world right now? If so, does that mean that the resolutions out of these consolidations will be the most important resolutions in the world? So here's the 10-year yield that's working its way on up, moving sideways there, just like the dollar index. This looks pretty correlated to me. So the 10-year yield and the dollar index are very correlated. And if yields move up, dollar moves up. Now the question is, are yields going to move down or up here in the near term? I don't know. I don't know what Powell's going to do. I don't know if they're going to continue to drift higher like they have been. We'll see if crude oil is also another one that's highly correlated to this. Oil yields and index are all highly correlated. We'll see if crude oil moves on up. We could have a period of a slowdown in the short term before that occurs. But we'll see. JC Parrots again, it says, these are historically great prices to be accumulating natural gas, but it's the timing that is key here. Wind, moon. I agree with that, but I think I'm a buyer down here, guys. I already bought a bunch. Not of, the equities didn't pull back as far as it did in 2020. 2020 was like the anomaly of a lifetime. You go back and look at the natural gas equities, they were so cheap, and they were also cheap against the physical metal itself. It's not that same setup as it was before. I think the uranium equities, in terms of valuation in relationship to the physical metal, are priced a little bit better. But nat gas and some of the companies, I think there's still some very good setups. Very, very good setups. Sherry says, or Cherie, however you pronounce it, people don't quit their jobs, they quit their boss. True or false? I would say it's mostly true, but not all the time. Your boss only has so much control over how much you get paid. So I do think pay comes into it. You can have a good boss, get paid pretty crappy, and say, you know what, I got to go somewhere else to get paid better. But you could also have a crappy boss and get paid very well and leave the job because you don't like the boss. And the job itself, And I don't know if this is tied to the boss necessarily, but sometimes your job, you'll get hired as one thing and then you're working on something that has nothing to do with your job title. And you're like, I don't like doing this. And I don't know if that you'd attribute that to the boss or to the company or whatever, but your job can change over time and you may not like what you're doing and you're just like, screw this, I'm out. JC says the equally weighted indexes are dancing around the prior cycle's high. So this is the S&P 500 equally weighted and the NASDAQ equally weighted. Are we pulling back? Are we going to break out here? And that's where we don't know. Are rates going to go up or down? Things are kind of in flux right now. I'm seeing a lot of data that kind of it doesn't contradict each other, but it just doesn't match. So I think that fiscal spending is hiding some of the things. We're seeing some weakness in manufacturing data. We are printing a lot of money, fiscal spending like heck. So it's stagflation. It really is. We've got inflation and things are contracting at the same time. And I'll be honest, guys, the data doesn't match today, doesn't match what it has since I've been investing in the beginning. So things are a little bit more wonky, and that probably is because of stagflation. I love this chart here, guys. So oil can easily fall to the low 60s inside of its blue flag. But once it breaks out, price will likely see multiple triple digits. This is a mega bullish setup long term. Totally agree with that. This is your big consolidation, your massive bullish falling wedge. We've broken out, retest. Do we have one last retest? I don't know. A lot of people they talk so confidently, and I know people want confidence. I want to hear somebody who's real confident. It's like confidence doesn't get you money though. So what you do is you wait for the setup, you buy on support here or wherever, and you hold on and wait for the break. Like I'm fairly certain that this will break up. The question is when, and I don't think getting the win perfectly right means that you make any more money. I think you should just buy cheap assets that are at really good technical, levels, and then just hold on. That's kind of my view. And this chart signals a much higher move. And that's what we've got for today, guys. So give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you'd like. And we'll catch you guys next time. This is Finding Value.